Hey everybody, this is Jose. How are you all? Wonderful. Yes, we are about to start our session in 25 seconds. Let's use this time for a sound check. Please, quick message on the chat box, just so I know you hear me. A quick hello would do. Any message really. This is just a sound check. We start in 10 seconds. Wonderful. Thank you so much, Mark. Good to see you. Good to hear from you. Frank, how are you? Very nice. Very nice, everybody. Okay. So we just reached the top of the hour. So it's time to maximize our introduction slide so we can have an official launch of the session and, we go for it. Okay. So welcome, everybody. Today is February the 2nd, 2020. Oh, I just forgot to turn on the camera, by the way. How are you, everyone? Good to see you. So as I was saying, February 2nd, 2020, today, my name is Jose Blasco. I will be your guide. And today, the goal is to sharpen our skills. Okay, so we're getting together for sharpening purposes. We'll be looking at your needs in general. We'll be looking at your questions in general. I have a few things I would like to address as well. I have a few questions that I have received on emails that I would like to answer in the session because sometimes, emails are certainly a great way to communicate, but sometimes, there is how much you can write in a paragraph, isn't it? So I'll use also today's session to answer some of those questions, and that's the purpose of getting together today. Okay, just going over certain key parameters and portions of the process that we use when we do short-term trading or long-term trading. Okay, but also look at your questions. Okay. Very good. Very good. I'm just reading your comments there. Pansy, how are you? Yeah, wonderful. Yes, Pansy, by the way, I was reading an email from you earlier today. And just know that we have replied with answers. Osman, how are you as well? I was also reading one of your emails today. So nice. Very nice to see you here connected live. Okay. Anyway, so we're about to start. I just got the disclaimer left, so I'll do that and we go. Disclaimer: the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. And this is the introduction for the session. And I'm bringing TradeStation to the main screen. Let me close the introduction slide. And we're going to be bringing many more things as well, isn't it? We're going to be bringing documents. We're going to be bringing trading view. So we're going to be doing multiple things, okay? But one at a time, okay? So Charles, how are you? Good to see you, Charles. A pleasure to have you in the session with us as well. Very nice, okay? So look, let's do this. So that way I can give you a little bit of time to word your questions in case you have any question. Okay, so again, I'm going to be taking questions and providing answers today. Some of you have been applying the methodology for a while now. Some of you are new to the methodology. So, I would expect that all of you have questions of whatever type. Okay. And I'm happy and willing and ready to answer all those questions. Okay. No matter the origin of the question, if you wish, when it comes to your process and into trading, utilizing the apps, diversifying yourselves, the use of the time frames. I don't know, you name it. You go ahead, and I mean, if there is something I could not answer, then I will let you know I could not answer. But I'm ready to discuss anything that is related to what we do, guys, and where I could help you. Okay, so be ready to word your questions. Okay, a quick message on the chat box would do. Okay, so and your question may be a short message, but the answer could be lengthy and could take me, utilize multiple charts to demonstrate or illustrate the answer. And if that's the case, I'll do it. Okay, so think of today like a dynamic lesson day where you set the title of the lesson and I deliver the lesson for you if you wish. Okay, so be ready to ask for whatever you need, and I will be covering that. Okay, also I have, as I said before, a few questions from emails that I would like to address. They are very good questions, and sometimes when a question is difficult to answer in an email, or sometimes when a question is so good that you want to share with the whole community instead of only answering the person who formulated the question. So many times you have seen me before, and today is not an exception. You have seen me use the sharpening sessions to be able to provide answers that hopefully help everybody. Okay. So we're gonna do that. But while you guys are working on, wording your questions, etc., so what I would like to do is I would like to start with looking at the process and how we trade, the different tools that we use when we trade. I would like to go kind of give you a tour. Today is the first 2020 sharpening session that we do, isn't it? So today I would like to take you in a tour where, if you didn't know we existed, if you didn't know what is AutoUFOs, if you didn't know what trading is, so I would like to kind of take you into a tour and have a little bit of a healthy reset, where we looked into everything we do when it comes to what do we trade, which tools do we use, how does a process look like, what is important in the process, the rules, etc. And this, I think, it's gonna help a lot to clarify many things that some of you are wondering or realizing, as you practice the methodologies. And it's healthy from time to time to have one of those resets. Okay. And I think that I will start the session this way today. So then later I'll take your questions and we'll get even more specific, even more concrete. Okay, sounds good, everybody? Ahmad, how are you? Good to see you as well. Very nice. Okay, so everybody just be ready to discuss anything, address anything at any moment. Okay, cool. Okay, so first thing. Okay, so let me go ahead and get a blank screen here. Okay, so what is the first thing I would like to discuss? Okay, I would like to discuss, first of all, is trading. Okay, so you see I started very generic. Okay, so trading, or we can also call it investing. Okay, in the end it's kind of the same, even though there are differences, but in a generic form is kind of the same. So trading and investing, okay, implies you exposing yourself or you exposing your money, which is in a form of exposing yourself to the marketplace. Okay, and the marketplace, like everything in life, got opportunities and dangers. Okay, everything in life is the same. The market is not a difference. Okay, and so what's key when you approach trading, okay, what's key is that there are certain things or certain tools that you should be thinking of, or certain mindsets or approaches that you should be thinking of to not to get in trouble. Okay, so first of all, I need to make sure that you guys are trading the right asset. Okay, asset or assets if you trade more than one. Okay, in the sharpening sessions, okay, we've been looking into forex, which is currencies. We've been looking into futures. That's our bread and butter in the short-term sessions, isn't it? We've been looking into stocks and options. Okay, stocks or options. Again, there are many assets, outside of the US. There are CFDs or spread betting products or other products, and all of this is tradable. So the first thing that you need to understand when it comes to getting into trading is that you use the right assets. Okay, this is one of the initial questions you need to ask yourself. Okay, and then once you have the right assets, okay, you need to make sure that I'm not going to say that, of course, you need to understand what you're doing, you need to be properly trained, you need to have a certain degree of knowledge. I'm not going to say that, because I would say that's kind of obvious of everything we do, including cooking, for example. If you don't know how to cook, good luck. If you don't know how to trade, good luck. So you are with me on that, right? But the moment you got all that knowledge with you, the important thing is that you surround that knowledge with a proper process that makes you mechanical. Okay, so that is super important for you to think about, because if you have all the knowledge in the world, but when you apply trading, every time you enter a trade because of a different reasons in a different way, then your action will be random. Okay, and the beauty of mechanical is that mechanical will impact your actions to be constant, constant, repetitive, consistent. Okay, And therefore, if your actions are constant, consistent, repetitive, then your results should be the same. Where if your actions were to be completely random, then your results would be random as well. Okay, so yeah, I'm just noticing the typo there with the mechanical. Okay, so mechanical. That's what I meant. So anyway, this is a very generic statement, and hopefully no one is surprised by this, because all of you should be very clear on what I just wrote here. Okay, but it's very important. Okay, so now when it comes to uh, now you decided which assets you trade, and now you understand the importance of being mechanical. So then the next question is, okay, so what's my style? Okay, because in order to be mechanical, okay, your style of trading, okay, which has a lot to do with your time exposure, okay, time exposure. Okay, so what's your style, meaning how long you like to stay on the trades. So your style has a lot to do with being mechanical and using the right asset. It's all related, because in the end, the person who's going to click the button is you. We happen to be human beings. We happen to have other responsibilities in life. Maybe you have kids, maybe you have a demanding job, whatever that is. But in the end, most people have limited time. And apart from whatever limited time you may have that may dictate your style, there is another aspect which may or should dictate your style, which is what's your mindset. Okay, and mindset is your trader psychology. Okay, so what's the type of psychology you have? Are you a trader? Are you a person who is normally very, let's say, aggressive, lacking patience, kind of like a doer type of personality? Or are you more like, a planner, look at things, carefully, take actions, once everything is under control, with no rush, et cetera, et cetera. So you get my point. I mean, those are concepts that we've discussed many times in the sessions. But again, the two of those, okay, so your time exposure together with your psychology or your mindset dictate the type of trader you should be, which is your style. And your style, you probably remember that we talked about things such as intraday traders, swing traders, position traders, long-term investors. And this has many different connotations, because in the end, if you remember the one thing we just said, which is we want to be mechanical, okay, well, being mechanical will imply tools, okay, for example, will imply the use of specific time frames, okay, and the time frames will be different depending on your style. So let's say you were to be a person who decides to do intraday style, you are going to end up using time frames which are different than a person who is a long-term investor, and you have to be mechanical with those time frames. So what you would not want to do is to keep jumping back and forth from time frame to time frame, just making up market opportunities or looking for anything that may look like appealing to you because of whatever mysterious reason, and then you want to trade. So the idea is, before you start trading, okay, as I said, make sure you are using the right assets. Make sure you are approaching trading mechanically, which means that first you need to decide based on your psychology and your availability for time exposure. Maybe I should add money as well, because of course, maybe making 20% a year may be enough for an investor. If the investor got an account with lots of capital. But if you have an account which is very small, making 20% a year is going to make the account to grow 20% of small is 20% of small, So depending on the amount of capital, this may also impact your style. But again, I didn't write it because that's kind of obvious. But your time exposure and your trading psychology are things that people normally don't tend to think about. People start trading, like, for example, maybe you saw me in one of the get-together sessions doing short-term intraday, and you kind of like it, and next thing you know, you start doing that, and you never ask yourself, should I do intraday? Maybe I should do swing, or vice versa. Maybe you saw some of the swing trades and you like it, but maybe given your personality or your account size or the time of the day at which you can trade, maybe you should do intraday. Okay, so defining your style has a lot to do with defining all the different parameters, okay, all the different parameters of your methodology, okay, and your methodology needs to be made of rules that you then follow with impeccable discipline. Okay, and that way, now you take the methodology, and because you keep following the rules with discipline, you have this consistent action. You have a process, okay, and that consistent action will produce consistent results. Okay, so again, all of this is, as I said, a hard reset. I would expect that most of you know this. This is not the first time in your life that you are listening to something like that, I guess, right? And therefore, in the process here, in the get together sessions, okay, the process that we have been running, basically we came up with flowcharts, okay, flowcharts that basically illustrate, okay, flowcharts that illustrate the process that I just explained. Flowcharts that, like all flowcharts that define a process, the flowchart comes with all sort of documentation that gives more detail of what each of those boxes do. For example, timeframes. Okay, so you have the flowchart, and then you have the timeframes that tells you which timeframes to use depending of which markets do you trade. Okay, and all of this is defined within the process itself. Okay, so now up to this point, I've been very, very generic, okay? And now I would like to begin having some steps in the direction of being more and more concrete. So let's, in this process of doing a hard reset in this first sharpening session of 2020, so let's get to understand the process, okay? And by the way, some of you, maybe not everybody, I would expect not everybody, but some of you, and I'm just loading another document here, just 1 second, guys. So some of you may have noticed, okay, some of you may have noticed that when it comes to flowcharts, actually there are two flowcharts, okay? Flowchart number 1, you have it on the screen, and flowchart number 2, you now have it on the screen. And it's very similar, very, very similar, okay? So where are those flowcharts coming from? Well, I'll go back to flowchart number 1 first, okay? So flowchart number 1, okay, this is number 1. This flowchart is coming from a training that we have been doing, that many of you have attended, not everybody, but many of you have, a training that we call Survival to Mastery in Action, okay? Actually, it's not exactly that. It's Survival to Mastery Forex in Action. That's exactly how we name it when we have been running this training, okay? This is a training that we have been doing a few times, you know, since November. The last one we did it at the end of January. The next one will be February 24 to 28, okay? And these have been online classes, okay, that we have been running, where, you know, I've been working with the group, taking the group from survival to mastery, because this is the path of success in trading. Many people want to trade or learn how to trade, and basically what they do is that they start trading, you know, with plenty of knowledge but no structure, and they have random action, they get random results, and then they wonder why. So in this program, what we have done is to kind of invert it, okay, and focus on what's most important first, focus on good practices to not to get hurt in the marketplace, and from there add more tools, add more processes, add more variations, add more options, in order to get from that basic stage of what I would call basic trading to more advanced in the way to mastery. Okay, so again, so we've been doing that, and many of you have attended this program, and you know, I'm glad we did that. No? At the same time, when we have done those programs, we've been doing 5 days, 3 hours a day, okay, and we've been doing that online. So when we do that, what's the problem? The problem is that if you count the amount of hours, that's 15 hours. Okay, and teaching someone how to trade in 15 hours, it's quite tight. Okay, we covered a lot, a lot, a lot, a lot. We did a lot, a lot, a lot, a lot, but at the same time, it's very difficult to be able to cover everything. Okay, so that's why for the ones of you that attended this training, then I told you, then after you are done with the training, join me in the get together sessions, and we'll take this flowchart, this process number one, we'll take it to the next level, which is flowchart number two. Okay. And what's the difference? Well, the difference are a few boxes. That box, for example, that box, for example, that box, that box. Okay, so there are a few boxes here with the name optional, optional, optional. So all those optional boxes, okay, they were not covered in that 5-day training uh, because it would be too saturating. It would limit time for other things that are more foundational in this process going from survival to mastery, and therefore we didn't do it at that time, but we do it here in the sharpening sessions. Okay, and we have recorded videos which I want to show in case you are one of those students, so you know where to find it. Okay, so let me load it, just one sec, and I will share my my browser in just a minute. So I'm just loading our YouTube channel. Okay, just loading our YouTube channel. By the way, I always forget, but if you have not clicked on subscribe, go ahead. This is your time to click on subscribe, and then hit the bell so you get real-time notifications. Okay, just in case you haven't yet. So this is our YouTube channel that you are all using now, and under sharpening there is a pretty lengthy playlist with many videos. Okay, actually I would even say maybe there are too many. Okay, but I guess it's a good problem to have. It's better to have too much content than too little, isn't it? But anyway, if you scroll down, for example, there is a session that we did. Where was it? Right there. That was in October, or at the end of last year. That was the trading flowchart. And this trading flowchart, this video, which is a little less than 2 hours, that video is, let's call it version 2 of the flowchart. Going back to the flowcharts I was sharing with you, this is version 1 with 1, 2, 3, 4 options for trade management. And this is version 2 of the flowchart with 1, 2, 3, 4, 5, 6, 7 options for trade management, and also optionally the use of reactive timeframes before you execute the trades. Okay, so you know more stuff. So this flowchart was properly explained in that video. And if you are new to the sessions or you didn't know the video existed, then I think it would be quite healthy for you to go ahead and be part of it. Watch the video because it will probably help you to answer many questions. Okay. Now, so let me go ahead and give you a quick, even though we have a full 2-hour video on the flowchart, I would like to touch on what's key in this reset process today, right? So remember we said, first thing you need to do is decide the right assets, make sure you have a mechanical process that depends on your trading style. Here is the mechanical process, okay? So now let's dive a little deeper into the mechanical process, okay? So the mechanical process starts here, okay? Let's call this step 1, then we go there, let's call this step 2, and then we go here, let's call this step 3. Okay, so basically it's 3 steps in order to execute the trade. Okay, and basically what we do here on the first step is to check the climate, okay, and then set the target. So let me tell you what we're doing, and then let me tell you why we are doing it this way. Okay, number 2, we check the entry. Step 2, we check the entry. Then when we go into the third box, then we define the stop, we define the size, and then we set a safety target. And with all of this, we're ready to go. Okay. So really, if you think about it, we need 1, 2, 3, 4, 5, and 6 pieces of information to be able to execute the trade. But those 6 pieces of information are coming from following 3 steps in the process. Okay, which are the 3 boxes that we saw. Okay. Now, why are we doing this the way we do? Okay, so remember, climate, the purpose for climate, which is where we really start, it's to let you know if it's time to trade or not. Okay, do you have a favorable climate, yes or no? because if it's not time to trade and you were to make up a trade, you're going to get in trouble more often than not. So the first thing is to know if it's time to trade or not. And once you concluded, okay, green light, it's time to trade, the second part in the process is to go ahead and decide the direction of the trade, which is part of the climate too, meaning is it sunny or rainy? Okay, is it sunny or rainy? Um, because if you were to enter the market and you happen to be on the wrong side of the market, okay, the large market players are buying and you're selling to them, or the large market players are selling and you're buying from them, then it's not going to work either. So climate is critical, and that's why it's at the top of the process, is the first step. So once you get a green light that tells you, okay, time to trade, the next thing to do, to not to waste time, is to check the target. Why do we check the target in the beginning part of the process? Well, because if you were to look into, okay, so what's my entry, what's my stop, how much money do I need to put in this trade, you do all the remaining calculations to then conclude that the target is too close and the trade is not worth it. You basically wasted a lot of your time just to conclude the trade is not worth it. So here what we do is look at the target, and if the target is it's too close, so then basically you're going to go for another market. Okay, if you were looking at the S&P futures, then you go trade crude oil. If you were looking at crude oil, then you go trade the euro, and that's it. No wasted time. Okay, so that first box basically, it's to either give you a green light for the trade from the climate and target point of view. And if that's the case and you have a green light, now you're going to go for the second box, which is, okay, so now that I know my direction and that the trade and taking the risk is worth it, so what price do I buy at, or what price do I sell at as an entry? Okay, and then you spend some time doing that. And finally, once you got the entry, then you also need to, because up to this point, everything is optimistic, if you wish, right? So you have been looking at the climate, the climate tells you go long or short, whatever. You have been looking at the target is far enough. You have been looking at the entry, you are convinced that's a good entry. So up to this point, it's all optimistic. So the third box is to get pessimistic, which is, okay, what if I'm wrong? Okay, what if I'm wrong and the market goes, moves unexpectedly, right? What if the market doesn't move as I expected it to do based on the prior two boxes? So what am I going to do? So of course, we're going to use stops. So you have to define the stop in order to not to be killed on the trade. We know that the size changes the risk of the trade. So we're going to define the right size to have the right risk. Okay, and also for additional safety purposes, okay, again, in that pessimistic mode, we will add a safety target. Okay, so the box below, it's all about the pessimistic side of the trade. The two boxes above, it's all about the optimistic side of the trade. Okay, if you wish, maybe that's one way to think about the flow chart. Okay, and then you just go execute. Okay, do you have any question? How is it going? Duyan, how are you, my friend? Good to see you. Very nice. Cool. Okay, so feel free to interact with me, guys. If you guys have any comment or any question, go ahead. Okay, and you could. It doesn't need to be a question. Okay, if you want to say, hey, you know what, that safety target, is helping me a lot, or that last week this happened to me and I realized that. Guys, feel free to interact. This is teamwork. Okay, we all learn from each other. I am your guide. I am leading the session, but it doesn't mean I have nothing new to learn, or that's it. Okay, we are always learning in life, and remaining humble while confident. It's certainly a good attribute or a good quality. Okay, and even though that may now sound modest if I phrase it this way. Believe me, I do understand the importance of always being open to learn something else, something more. And your experiences, are very nice for me to hear as well, because they give me realizations either for myself or sometimes to feedback the community with, kind of anticipating things that may happen to you and help you better and avoid situations that could be problematic. Okay, so guys, feel free to interact, no matter if you have traded for 10 years or 10 days, it doesn't matter. Feel free to interact anytime. Okay, cool. Okay, so what else do we have? Okay, so we've been going through those three boxes in order to complete the plan of the trade, and now it's time to execute. Okay, so to execute, okay, and this is not available, when the ones of you that attended the survival to mastery Forex in action class. Okay, so the ones of you that attended that class, okay, and this is kind of like a fun acronym to write, isn't it? So the ones of you that attended this class, we didn't talk about the use of the reactive timeframes. We talked about that there is something that we call the reactive timeframe, but we didn't get to look at how to use it. Okay, so the reactive timeframes, to be honest, it's super simple. Okay, so if I was to look at TradeStation, and by the way, remember, while I'm loading the workspace here, remember the reactive time frame is optional. Okay, optional. So I'm gonna load crude oil, for example. Osman, Jose, can you put the info doc for rules of entry into trading effects to take a screenshot of it? The doc for rules of entry into trading effects. I think that maybe you refer to this. Let me, one sec. I believe you are referring to this. And I'm happy to bring it in the main screen. But most importantly, probably better for you, Osman, shoot an email to reach@tradewithufos.com, and we'll send you a copy of this document. Okay, and that's it. So there is a portion in here below. Okay, and remember, this document, when I wrote it, it was, just to have something to support the teaching, isn't it? And to have some, here we go. Yeah, those are the rules. Here we go. And to have some written note that could help you, okay? But again, I apologize for the format because it's not the best format in the world, okay? Okay. Cool. Okay, so I was talking about the reactive timeframes, and I may not have given you time to take a screenshot, so I'll leave it there just a couple of seconds, and then I will continue. But again, the best is that you send an email, and I will send this document to you. Okay. GWAC, good morning, Jose. Despite matching the calibration settings on the auto UFO indicator for TradingView, I always see a difference in the UFO levels between TradingView and TradeStation during our morning sessions. Okay. In which market, GWAC? You're talking about Forex, I am guessing, isn't it? Because if it's Forex, it's going to be a pretty normal thing because each data feed from a different broker is going to provide different with options. Okay, well, then that's a strange thing. So I'll look at that in a minute. Okay, I'll look at that in a minute and we'll see if that's the case or not, because it should not be the case at all. Okay. Okay, so anyway, so we have the crude oil here, okay? And so let's say, for example, you decided that it was time to take a trade, okay? Which at this moment in time, we don't, because, the climate is not confirmed, for example, et cetera, okay? But let's pretend for a minute that you decided that you were going to buy using that green UFO, okay? And what's happening is that crude oil is coming, and enters the green UFO. So what are you expecting to happen? Well, you expect it to go up. Why? Because the on-field orders will kick in and the market is likely to go up. Okay, that's what we expect. But again, this will only happen if the on-field orders that we expect to be are not canceled. And they could be canceled last minute, last second. Remember, the way the markets work nowadays, it's all about computerized trading systems. It's all extremely dynamic. Nothing is static any longer. That was in the 60s and the 70s. Okay, so drawing a line in the chart and keeping that line there for a month and hoping everything's going to be the same 1 month later, in the world in which we live, it's certainly not realistic. Okay, so everything is dynamic. So now I want to add one more comment to what I just said, which is there is a reason why those on-field orders were there in the first place. And assuming the reason why those on-field orders was there in the first place was not to change, okay, and plenty of the on-field orders have to do with fundamentals, have to do with fund managers and so on. So, those guys, they want to buy or they want to sell, and the reason will remain for a while, then as long as the reason is still a valid reason, so the orders will remain in place. But at the same time, then you also have all the automated trading system, the trading robots. You have all sort of speculation methods that are not looking at midterm or long-term reasons. They are looking at extremely short-term reasons, like what you would find in 2-minute timeframes and things like that. And therefore, everything is super dynamic. Okay, and I'm sure that we have all seen at times that the market comes to a UFO, and next thing you know, it goes through like the UFO was not there. And when that's the case, you know what happened. The on-field orders were canceled. That's it. It's that simple in the end. So not a big deal, because we work on probabilities. We have the climate. We have, we use a moving average too. We use the right sides. We use stops. So when that happens, we lose little. When what's likely to happen happens, which happens more often than not, then we profit more, and overall we end up profitable. I heard from you since the beginning of the year. Many of you that were attending the sessions have been practicing last year, either with very small accounts or paper money, and starting 2020 you started trading live. And now that the month of January completed, I received already some emails from some of you that were keen and kind enough to shoot me emails over the weekend to let me know how January went. And you guys are doing well, which is fantastic, and I congratulate you for the work and the effort, because this is the reason why. Okay, so it's all about you, and therefore congratulations. But at the same time, still sometimes price may go through a UFO, right? And as I draw the line like this, okay. And again, I'm adding a little bit of additional comments when it comes to trading psychology. So some of you are looking at the line like this, and some of you are like, oh yeah, this happened, not a big deal. But others, you're looking at the line, and by the way, feel free to share your opinion or your feel when you see a line like that on the chat box. Some of you, I'm pretty sure, are feeling the pain, right? You see the line like that, and instead of feeling it like, well, it's okay, it's part of trading, which is how you should feel. Okay, which this, by the way, comes through experience and practice. Sometimes it happens like that, sometimes it doesn't, and it's not a big deal as long as you have stops. But some of you that may be newer or more perfectionist, and you are shooting just to be right. You just want to be right. I want to be right. I want to be right. I want to be right, which is certainly a normal human thing, but not the right approach to trading, as we discussed in prior sessions based on trading psychology, isn't it? You need to have a carefree state of mind, not a state of mind where you care so much that you see a line which is just a blue line and then you feel the pain, right? So we need to help you to change that mindset if you are there, which could be the case. Okay, and by the way, just for you to understand, I went through this phase myself. Okay, my background, some of you may know, my background was engineering, and certainly engineers were used to the sure thing. So when I started learning how to trade, and I got trades to work against me like that, like dramatic moves against me, I could not stand it. I would be like, what did I do wrong? It's like I was very uncomfortable in my very early stages. Okay, so if you are like that, I totally understand, but we had to change that. Okay, because this is gonna be part of trading too, and it's not a big deal as long as you use stops. It doesn't matter if you get stopped out slowly or fast. Actually, it's better to be stopped out fast, because then you have more time to plan a new trade, instead of you waited 3 hours and then finally you got stopped out. So you get the same pain, and on top of that, you wasted your time. So it's all about how you look at things. Okay, but again, it's easier to be said than to be done, especially when you're new. You have to develop practice and experience to get to a point of basically having those life lessons, trading lessons, aha moments, etc. Right? But anyway, basically, for the ones of you that feel pain when you see the blue line, that's when the reactive timeframes could be useful. Okay, so all this conversation, guys. Okay, I haven't lost my my reason to talk about all of this. The reason to talk about all of this is the reactive timeframes. Okay, so the ones of you that when you see something like that, you're like, oh my god, right? And you feel uncomfortable. So those are the ones of you that will probably enjoy the most using the reactive timeframes here in the bottom right. Okay, and so quick summary, a quick reset on how to use the reactive timeframes is the following. Okay, what you will want to do is do everything else according to the plan. Okay, so you do everything we discussed before, and optionally, when you have already the whole plan of the trade in place, and therefore in this example with crude oil, you are expecting a bounce to happen from that UFO, right? So what would you do? Well, you would allow crude oil to come to you, and the moment crude oil comes to you, or another way to say that is come to your selected UFO, instead of taking the trade like most of you are probably doing, what you will want to do now is to start looking at the reactive timeframes. And basically, because it's a green UFO, then you would look at green UFOs on the reactive timeframes. You would ignore the red and only focus on the green. But by the way, you would not look at the green that are already on the chart. You would be waiting for, this market came down, and now you will be waiting for new green UFOs to form. Okay, and the moment new green UFO forms on the reactive time frame, okay, that one or that one, it doesn't matter which one, okay, or if it's one or two, it doesn't matter. Any of those reactive time frames, the moment any of those two charts give you a green UFO, okay, what does that tell you? Well, it tells you that the place on the chart where you expected on-field orders to be is showing you that on-field orders are available. In other words, it doesn't look like on-field orders got canceled. And this would certainly give you a higher quality or higher probability entry points, even though it has the downside of being more tedious and manual, and you have to do a little more watching. And by the way, sometimes, sometimes instead of being like that, where that tiny UFO, it's produced, somewhere here, under 5140, and therefore now your entry is down here and your stop is here, okay, right above 30. Sometimes what may happen is that price comes to the green UFO, starts bouncing, and now you get the UFO in here. Okay, so now you want to trade, but what's the problem? The problem is that you are buying right under 50, where your stop is still above 30. So now basically you got even more risk now than before. Instead of less risk, you have more risk, but you also have more evidence and therefore more probabilities. So what is right or what is wrong? Well, it's not about right or wrong. It's about pros and cons. Okay, it's just like you buy a car. Okay, there are many cars in the market. Many of them are cool, but none is perfect, and all have pros and cons. Okay, and you will have your preferences, and it has a lot to do with your driving style. In this case, your trading mindset. Okay, so this is why we have on the flowchart the reactive time frame optional step for the ones of you that feel that it adds a certain degree of comfort that you value to be able to trade more efficiently. So you can certainly go ahead and use the reactive time frames. Again, for the ones of you that attended the survival to mastery, okay, Forex in action class, okay, either at the end of November or at the end of January, or for the ones of you that will attend the class at the end of February, notice how we don't have the reactive time from here. Okay, we don't have it, and the reason why we don't have it, it's on purpose. Okay, so we have more time to focus on doing a good process with everything else, because the reactive time frame is optional. And if you didn't have a good process with everything else, it doesn't matter how good you use the reactive time frames. If the remaining part of the process is not well done, then probabilities are not on your side. Okay, so that's why we also have the reactive time frames. Okay, cool. Let me see the questions, okay, before I keep going. Ruben, how are you, my friend? How are you? Good. By the way, Ruben, I have a question from you, which I plan to answer today. Okay, so if you could stick for a little longer, you'll get your answer in the session. If not, you can always watch the recording, obviously. But it'd be great if you could stick around. So if you have a question to my answer, we can interact live. Okay. Okay, so what else? Then we get into order placement, and then it's either you get filled or you don't. And if you get filled, now we get into trade management. Okay. Now again, for the ones of you attending the survival to mastery class, we have 4 cases. Case number 1, number 2, number 3, number 4, which is okay. What could happen to your trade? Well, you get stopped out. What else could happen? It moves your way for a little bit, hits your safety target, and then continues, or hits your safety target and then turn against it. Okay. What else may happen? What may happen is that the trade starts moving your way, may even hit your safety target. Okay, so maybe you were planning to buy where that UFO is. Okay, and guess what? Price came in here. Okay, that was your entry. below was your stop, right? And now price starts moving your way, same distance, okay? So that's your safety target. So you scale out, okay? And then let's say your final target is all the way there, right? And this keeps going and keeps going and looking good, looking good, looking good, looking good. But suddenly now we start having a change of climate, okay? So if we start having a change of climate, what would you rather do? Stay in the trade and hope for the best and expect it to go there even though the climate has changed, or position yourself, assuming you have a good market setup, get out of the trade, lock in whatever profits you got, which in this case it would not be much, but whatever it is, thank you market, and then position yourself to ride whatever new coming move to the downside is going to be. What would you rather want to do, to stay and hope or adapt, right? So basically climate change, okay, it's our third type of trade management action in order to always be adapted to the climate in place in the marketplace. And finally, of course, the sweet spot is when you reach to the final target and you get out. Okay, so this is what we do in a basic form, and this always should be done. Okay, for you to be in a safe place, but also here in the sessions. Okay, in the get together sessions. Okay, and again, I pointed at a specific video in the YouTube channel earlier, isn't it? So let me flash it one more time. Okay, for the ones of you coming a little later, the video from October where we talk about the flow chart. So in that video, we talk about the different trade management techniques. Okay, and notice that stop loss is still there. It's the same one we just discovered, but also we add a time stop. Okay, and what is a time stop? Okay, and by the way, I do have a question later to address when it comes to time stops. So what is a time stop? So a time stop is a stop based on time. In other words, if let's say you have a climate that suggests, so step one, the climate suggests price is going to move up. Let's say the target is very far up, okay? So your entry is below here, your target is very far up, okay? So nice amount of money to be made. Let's say you have a good entry, okay, with a stop located below, so you're risking little amount of money compared to the amount of money you're gonna make. Okay, so everything is looking good, right? Well, if all of this is true, and on top of that, you know, when you plan your entry, you put together direct forces with indirect forces, isn't it? And again, we talked about that in that course, right? So remember, when we plan the trade, isn't it that we use UFOs, right? This is a direct force. It's on-field orders waiting to get filled. But isn't it that we also look for EMS that line up with the UFO, right? Why do we do that? Because isn't it that sometimes a price comes to the EMA, bounces, comes to the EMA, bounces. So why is it that price is bouncing from the EMA many times? Well, because computer systems are buying at the average price. In other words, computer systems are injecting on-field orders. Okay, computer systems are injecting on-field orders. And in other words, so if you have a UFO lining up or enveloping an EMA, you have on-field orders already available in the market that is given to you by the round circle, but you also have on-field orders that may be added that is given to you by the EMA. So the EMA is an indirect force, the UFO is a direct force, and when you put the two together, now you have more odds. So long story short, okay, following the rationale of our trading process, okay, if the climate is in your favor, if the target is far enough, if you have direct forces and indirect forces together, I mean, if everything I said is true, okay, and that was your entry point, okay, and that was your entry point right here, right? And the market just came to you, right? So the market should move up quite efficiently. Why? Because you have so many things in your favor. But sometimes we see that you have a UFO, okay, same setup, the climate, the target, you know, the direct force, indirect force, everything is in place, but then the market comes in here, and then you got something like that. And it doesn't really take off. And it does really nothing, right? So when that's happening, we got a problem. Whatever you thought was true, it's kind of being proven to be partially true, but not fully true. And on top of that, and this is the worst part, the direct force, which is the on-field orders, they are being filled. All this time where price reaches the circle, that means orders are being filled. And the more orders get filled, the less on-field orders will be left available. And therefore, the probability is going down the longer the time you spend without the move happening. All that time kills the probability. Okay, so if this resonates with you, but then using time stops may make sense to you, which basically a time stop means that, okay, you take the trade, and after you take the trade and you got filled, okay, you have the stop in place, that's for sure, in case the market just collapses. Okay, remember, we have the UFO. Okay, and one thing that could happen is that price comes to the UFO, you expect the bounce, but instead it goes through, right? So again, if that happens and you have a stop there, okay, so what? What's the most you can lose? The difference between entry and stop, not a big deal. Okay, so we always certainly use stops all the time. That's not optional. Okay, but here optionally, you see the word optional, we may use time stops. Okay, and by the way, if you don't have this document, shoot an email to rach@tradewithufos.com, and my team will be more than happy to email it to you guys. So you have it. Okay, so now, so the time stop basically is once you enter the trade, now you start counting candles. Okay, and basically the rule that we use is 3 to 5 candles. Okay, 3 to 5 candles, that's the rule. Okay, or 3 to 5 bars, if instead of candles you use bars, whatever. So 3 to 5, okay, is the rule, meaning that if you haven't reached the safety target, okay, which by the way, the safety target is quite close, isn't it? So this is the UFO, and if you think about the high of the UFO, okay, if you think about the high of the UFO, distance from the top to the bottom, the same distance projected above, that's the safety target. So if price comes here and keeps doing whatever, and haven't reached the safety target in 3 to 5 candles, so what the time stop tells you is get out. Just get out and that's it. And hopefully you collect a tiny profit, or maybe a smaller loss, or maybe break even. Okay, something like that. But get out, because this trade is proven to not to be high probability any longer. Okay. So what else? Safety target, we talked about it before. Climate change, we talked about it before. Next one, optional 2F to F. So what is 2F to F? 2F to F means too far, too fast. Okay, and here basically the problem with too far, too fast, okay, the problem with too far, too fast is sustainability. Okay, this is like throwing a ball against the wall. The stronger you throw the ball against the wall, the faster it will bounce back. So what do we do with this? Okay, well, think about your trade in multiples of your risk. Okay, so if you think of this is the entry and this is the stop, and therefore the vertical distance is your risk. So we already said that the same distance to the upside is safety target, but just in your mind, visualize and picture this multiple times. Same distance projected above multiple times, okay? And now two things may happen. Price comes to the UFO and begins moving up in ways where new UFOs are formed on the way up. So that's case number one. And that is sustainable. Why? Because if the market comes down to the next UFO, so what's going to happen? The on-field will get filled and it keep going higher. So as long as you keep having UFOs, this is likely to sustain, because if it comes down to the next UFO, it is likely to continue. Okay? So as long as you got UFOs on the way up, you're fine. What's the problem? The problem is that when you have a similar setup, okay, where you have the UFO, you have the top, you have the bottom, project number 1, project number 2, project number 3, project number 4, project number 5, right? And then that market comes to the UFO, and then the market starts moving your way, but instead of moving your way in a way that is calm and producing UFOs in your favor, let's say it goes up parabolically, right? With no UFOs on the way. So what's the danger? Well, the danger is that, somewhere there may be a UFO to sell, right? And if there is a UFO to sell anywhere, the moment this market is going to hit that UFO, so guess what's going to happen? It's going to just fall down all the way to where everything started, because there is nothing to stop it to fall. Here, if it falls, right, there is a UFO that is likely to stop it. But here on the right, there is no UFOs on the move up. Therefore, if it starts falling, it may just keep falling and falling. So what would you want to do in cases like that? That's when we hit or activate our too far, too fast stop. And basically what we do is, okay, so the moment we reach a safety target, okay, and there is no UFO that form, okay, if there is no UFO that form, the stop, okay, that is initially located below here, okay, the stop would be moved to where the entry was, okay? If it keeps going and it goes to the next multiple of the risk, then the stop would be moved here. If it keeps going and goes to the next multiple of risk, and this is assuming we haven't reached the final target, which is all the way there, okay? Because of course, if you reach the final target, you're out. So then you reach the next multiple, and what would you do? Stop goes there. Okay, you reach the next multiple, what do you do? Stop goes there. And you keep trailing stop, trailing stop, trailing stop. You hit the next multiple, and what do you do? Stop goes there. So now when the market crashes, what happens? You are out here, and therefore you manage to capitalize all these vertical size of the move in the form of a profit. Okay, again, it's optional, and it certainly requires manual action. You have to be watching the markets for you to realize these actions have to be taken, and those actions have to be taken manually. Okay, so that's why it's optional, and maybe not everybody will do it. Okay, and that's fine if you don't use it, because again, in the end, at the beginning, you had your stop loss down here, so your risk is under control. But certainly, it's a shame, and I'm sure that some of you have seen it before, right? That you get into a trade and it starts moving so nice in your way, and you get so happy. And next thing you know, you go use the toilet, you come back, and it's like, oh my God, what just happened? You just got stopped out. And you were so close to your target, but next thing you know, you got stopped out. And what was the problem? No UFOs on the way. That was the problem. Okay, so too far, too fast. Okay, it's that type of action. Okay. What else? Next one, the UFO trailing exit. Okay, the UFO trailing exit. So this one is also optional. Okay, we don't talk about it in the survival to mastery class, but we do talk about it here, and you see me use it all the time in the get together sessions, isn't it? So what this consists on what? So let's say you have a UFO, and this is your entry, and this is your stop, and the market comes here, and then starts moving all the way. Okay, and as the market starts moving, new UFOs form, new UFO form, right? New UFOs form. So as this is happening, you know that you have no reason to trigger the too far, too fast rule. Okay, you're just gonna enjoy this move, because you know that if price was to come back to some UFO, right, price would be reacting from it, or likely to react from it, because of the unfilled orders, right? So then now, if you listen carefully to what I just said, well, actually what makes a lot of sense is to be like, okay, so if those UFOs are going to help for the move to continue, why would I leave my stop down here? Okay, because if the climate was to change and this was to drop all the way to the bottom, I would end up giving up on all the profits made. So what about every time I got a new UFO, I just move my stop below? So if this market was to come to the UFO, and instead of going back up as expected, this market was to crash, then I would be stopped out where the stop is, and therefore I would capitalize on this vertical distance. Okay. Or what if the move keeps going, and now after I move my stop to this location number 1, a new UFO form? Okay, so let's move stop to location number 2. So now, if the market comes down, it's likely going to react and go back up. But if it doesn't and goes down, then I'm going to be stopped out at the same price right below that UFO, and therefore I'm capitalizing on all that move now, right? Or what if now a new UFO after this UFO form, another UFO form? So what can I do? Again, one more time, move your stop. Then all of those are manual options, okay? Where when the price comes here, is likely to continue, but if it was not to continue, so what would happen? You got stopped out at this price, and therefore you capitalize on all of these vertical move. Okay, and again, you keep trailing stop. We call this trailing stop, and therefore that's why we call this the UFO trailing exit. And you do it as new UFOs keep forming in any time frame you use. Could be the lower time frame, the higher time frame. We call them the edge time frame, the common time frame, isn't it? So you just keep doing that. Okay, cool. And finally, we got the final target. Okay, and once you have done your trade plan and then you execute the trade and you manage properly, then the last step is to log your trade so you can do review and everything else. Okay, so that's what we do. Okay, and that's the plan, and that's how we manage it, and that's what it is. Okay, everybody, cool. So I wanted to have this reset with you guys as we started today with our first sharpening session of the year, because again, it's important that we have a clear understanding of the steps that we take in order to do all of this. Okay, now one last thing I want to say before I give you a break, and then I'll take questions, is that each of the steps that we apply, here we go, each of the steps that we apply in the methodology, okay, use different time frames: common time frame, edge time frame, reactive time frame. Okay, so basically we have three time frames: the common time frame, the edge time frame, and the reactive time frame. And if you look at the screenshot I shared with you earlier with the specific time frames that we use to trade, we have the common time frame 15 minutes and the edge time frame 2 minutes, or could be shares or ticks. And in this case, depending on each market, you would have different numbers. So 2584 shares or 1597 ticks. Okay, but we also have the reactive time frames, okay, which again 610, 377 in the case of the S&P futures, but all those different markets will have different values. Okay, now this is for a person, this is for a trader who is very active using 15-minute common time frame. If you are less active, you use the 60, and therefore your 2 minute become 8 as an edge, your 2584 becomes 67, 65. If you want to take it more easy, if you want to take it easier, you use the 4-hour time frame. Now it's even slower. So now you use the edge time frame 21, and then you have all the other time frames. I mean, we talked about all of this in prior sessions too. If you go back to the again to the list of recordings on our YouTube channel, and you were to go down all the way, there are 4 key sessions, which are intraday 1 to intraday 4, where all those sessions, even though it's intraday, really, they talk about the use of time frames, and it could be other than intraday. And you have a lot of detail that explains the use of the time frames and why we use what we use, etc., etc. And it's all there. Okay, so you can go ahead and take a look. Okay. But anyway, again, one more time, going back to the flowchart, this hopefully is a good summary of the reset I wanted to do, okay, because understanding the process clearly, it's important, because, UFOs are amazing, but if you use UFOs in the wrong climate, it's a problem, because remember, in an up climate, sell on-field orders tend to be canceled, buy on-field orders tend to be added. In a down climate, buy on-field orders tend to be canceled and sell on-field orders tend to be added, and vice versa. So again, it's important that you use the right tools in the right context, in the right climate, etc., etc. And therefore, the importance of having the process that on top of that not only stack odds in your favor and forces you to not to forget anything, on top of that, that makes you mechanical, and this produces consistent action, and then assuming that you are impeccably disciplined with risk management, with the risk size, etc., etc., and all the rules involved, then this should produce consistent results in your trades. Certainly random action would not. Okay. Okay, so Mark, do you put the trailing stop at the bottom of the new UFO or one or two ticks below it? The same rules that we use for stops is the same rules that we use for trailing stops. So for example, in futures, Mark, you see me use one tick for the stop, unless we use currency futures where they use two ticks just to round to the next round number, because currencies normally if you were to trade spot forex, it would be pips, right? And pips is the fourth decimal place, isn't it? But putting that exception on the side, one tick is the amount of room I give myself for the stop. And for spot forex, I give myself 5 pips. You could give yourself less if you were to use very good brokers, but again, especially in the U.S. territory, forex brokers are very, very few, and therefore the spreads are quite wide. And if you happen to trade in the U.S., the recommendation that, or at least my examples in the sessions, is always using 5 pips of additional breathing space for the stops. So same rule would apply for the trading stops. Okay, Mark. Mark, does the micro ETF futures use the same timeframes as the E-mini? Micro ETF futures. Not sure what you mean by micro ETF. I guess that you mean the micro E-mini futures, I'm guessing. I think so. So yeah, I mean the recommendation to trade micros, okay, for you to trade micro E-minis, the recommendation is that you do not chart the micros. The recommendation would be that you chart the standard E-mini contract, like the ES, for example. But then when you execute using the different symbol, which is the E-mini symbol. Okay, not the E-mini, the micro E-mini symbol. That's what I meant. That would be the recommendation. Okay, but anyway, everyone, I'm gonna give you a 5-minute break. Okay, we'll come back in 5 minutes. We'll go over questions. Okay, and then we will conclude the session later on. Again, hopefully this little summary of important concepts is being helpful to you guys. Okay, and I will see you in 5. See you in 5. Okay, everybody, this is Jose. We are back and ready to continue. So before we go, a quick question. First of all, about the sound. Could you please confirm that could you please confirm that you hear me? That would be the first one. And second, Ruben, still around, my friend? I'm about to look at your question first, since it seems that you have to go. So hopefully you're still around. Sound is good. Thank you so much. Okay. So let's begin. Okay, question time. Okay, I got many questions, and the question really, it's almost like the best way to learn is through questions, because you get to understand concepts, plus you get to absorb the experience of other traders. So I love looking at questions for you guys and so on. Okay, and so here's a question. Okay, here's a question. All of you know now who sent this question, isn't it? And very well documented, by the way. Congratulations, good job. Okay, so here we got a question that has to do with an iron condor. Okay, it's an iron condor, and it was done with a stock YUM. At the time of the trade, statistics were suggesting a range between 1026 and 1016. That was the stats, and therefore an iron condor was done using two contracts as a quantity, selling two options, buying two options, as you can see, and the trade was executed this way. Okay, so here, let me zoom in a little more. Yeah, that should be better. So here we can see that the next action here that took place was to buy 200 shares. Okay, and why is that? Well, the reason why it's because even though the range of that stock was supposed to stay between, sorry for that, go back, was supposed to stay between 103 and 101.6. It seems that the stock, I'm not sure if there are screenshots about that. Let me check. It seems that the stock did not respect the statistical range, does not respect the UFOs either, and basically that stock just went higher. Okay, instead of staying between, I believe probably those were the lines he was using, this line and this line. So instead of staying in between, there was a major, massive move that brought the stock higher, and therefore the question was, okay, what am I gonna do? Okay, that was the question. Should I just let the trade, leave the trade alone, or what? Especially because the concern of Ruben here was, what if the stock keeps falling down and ends up between 104 and 106? Okay, so if the stock ends up between 104 and 106, that's a problem. Okay, and let me explain why this is a problem. So let me do some drawing here. Okay, so let's say this was the top of the range, and you expect the price to stay within, and that was the bottom. Okay, so you expect the stock to do whatever, something like that, something like that, something like that. Okay, but then you got a break, right? And now the stock is somewhere up here. Okay, well, if you think about an iron condor, okay, above price, okay, you had purchased a call. Okay, you had purchased a call and sold a call, and below the range you had sold a put and bought a put. That's an iron condor. Okay, so if the price went clearly above where the call is, it's not a problem, because as we covered in prior options sessions, also available on the Sharpening channel. Just one sec, guys. I need to confirm one thing very quick. Yeah, all good. Yes, perfect. So as we covered in prior sessions, okay. So if you sell an option, in this case a call, okay, and you buy an option above, so you buy a call above, you sell a call below, right? In his case, it was the 106 call above and the 104 call below. Okay, so if you do that, okay, and the stock ends up being all the way above that, okay, all the way above the range, then it's fine. I mean, it's a losing trade, but it's fine, because what happens is that on expiration, the 100 call will get you assigned shares of stock. Okay, because it's a call. Okay, because it's a call, you would be obliged to short shares of stock. Okay, and the one above, the 106 call that you bought, because the stock is above, okay, it's gonna expire in the money as well, and therefore you will be exercised automatically, and that will force you to buy shares automatically. And in other words, because you short and you buy automatically, so basically you get short, and this trade is kind of like a buy to cover. So no matter the sequence you think about this, one negates the other one. So at the end, you end up with a flat account. Okay, so you have nothing in the account. Okay, and the only thing you just collected is a loss, which is the difference between strikes minus the premium collected. Okay, the difference between strikes minus the premium collected, which is, as we know, the maximum risk of an iron condor. Okay, difference between strikes minus the premium collected. Okay, that's it. But Ruben's question was a bit more advanced, because it was like, okay, wait a minute. So this is my 106 call. Okay, this is my 104 call. Okay, I'm not concerned about the stock expiring up here. Okay, that's what he was thinking. He was not concerned about the stock. Sorry guys, I have a little problem with my mouse. He was not concerned about the stock expiring up there. His concern was, what if the stock goes up, surpasses 104, or goes even higher, and then comes back down. And when the option is about to expire on Friday, when the market is about to close at 4 p.m. New York time, what if the stock is between 106 and 104? So what if the stock is between 106 and 104? Well, now there is a problem, because basically what's going to happen is that the 104 call will be exercised automatically. So you will end up, as we said before, short shares. Okay, you will be short shares. But then the 106 will not be exercised, because if the stock ends up in the middle, let's say 105, so then this 106 call will be out of the money on expiration, and therefore nothing will happen with that call. It will just expire, and that's it. So what's going to happen if this is Friday? On Monday, okay, when the market starts trading, the problem actually even before Monday, but because the exercise will be done either on Friday or the weekend, on Saturday, depending if it's a weekly or monthly expiration option. But anyway, it doesn't matter. On Monday, that's a sure thing now. On Monday, for sure, when you look at your account, you're going to be short shares. So what if on Monday, the stock that was here, okay, the stock that was here on Friday at 105, what if on Monday, the stock opens and gaps up at 106? So what happens? Not only you lost the difference between strikes minus the premium collected, which is something you were happy with, but on top of that, if on Monday you have a gap up from 105 to 106, now you're going to lose another additional $1, because you were short shares. Okay, you were short shares at 104, and that stock gapped up by $1, which is $1 extra of pain compared to the pain you had on Friday. Of course, you can also have a gap down, and actually you make a profit on the shares, but it's a gamble. You don't know what's going to happen over the weekend, isn't it? So what Ruben was doing here was, okay, so what about right before the market closes? Okay, and this is Dubai time, if I'm not mistaken, and therefore this is equivalent to 4 p.m. New York time. I mean, this is 3:55 p.m. New York time. Another way to say that is 5 minutes before the market open. Let me say that again. 5 minutes before the market closes. Okay, what Ruben is saying here is that, okay, if the price of the stock is less or equal than 106 and more or equal than 104, in other words, if the stock is between the range, then buy me 200 shares of stock at whatever price. Why? Because if you are between the range, you're going to be for sure assigned, and therefore you will find yourself short shares at 104, okay, and at least if you collected 200 shares, and 200 is because you got two contracts, is 100 shares per contract. So if you got long 200 shares on Friday, okay, at the price at which the market was closing, okay, well in this case is 5 minutes before the close, okay, then if you were to have a gap on Monday when the market goes up, it really doesn't matter because the gap up would hurt the shares shorts you have, but it would help the buy shares you have. In other words, the moment you get short shares, they would kind of counteract with the buy, and then just like if the market went above 106, as I said before, you will end up flat in the account automatically. Why? Because you did have an extra step, which is to purchase 200 shares of stock 5 minutes before the close on Friday, before the options expire. Okay, so this is a pretty advanced action, which is certainly very smart in a situation like that. Okay, so we have the picture of the chart here. What else do we have? So a few comments. So let's read this together. So soy was going to end up the day of expiration between the short and the long call. Bought 200 shares to have the stock when I got assigned. And this is I believe this is sold and bought. This is the execution. So you can see here what happened. And basically, in total, I lost 174.41 minus 45, which is the premium received, which is 128.75. I placed an order to buy 200 shares of UM using a price condition to be activated 5 minutes before the end of the trading day. If the price of UM had been between the long and the short call, as we saw. Doing this, I don't know what would happen if the price of the stock during those 5 minutes, if the price of the stock during those 5 minutes until the market, yeah, I guess it probably means what if the price of a stock went higher or moved outside of the range during those 5 minutes, okay? So what would be the best way to buy the shares at the market at the time the market closes? If you put in the time condition 4 p.m., would it be triggered at that time? Or what would be the best way to address this kind of outcome when you see the price of the stock will be between the short and the long legs, okay? Okay, so well, first of all, Ruben, I would say that what you did is absolutely correct. Okay, so the action that you have taken is fine. Of course, if you are purchasing 5 minutes before the end, you got 5 minutes of risk for the market to come outside the range. And again, this is only important if so you have a range. Okay, so if you have a range, like this, and 5 minutes before the expiration time, the stock is somewhere in between. Well, buying shares 5 minutes before, it's perfect. Now the problem is, what if the price of the stock is very close to one of the edges? Okay, you may buy the shares, okay, and then what? Then it goes up, okay, or you may buy the shares and then it goes down. In both cases, it may add a little additional risk, okay, and and that's what it is, okay. So we cannot predict the future. That is always a variable in trading. So of course, the closer to the closing time of the day you are, instead of 5 minutes, 1 minute, the better. And what should you do? Well, that really depends on the stock you trade. If you are using a stock that is quite liquid, instead of 5 minutes before the close, maybe to make it a little more precise, you can do 1 minute before the close, and that should be plenty of time and more than enough time for you to get your fill. Okay. In any case, what I would do, though, it's to set an alert based on time. So if you were to find yourself in a situation where you are very, very close to the edge of the range, well, maybe what you could do is just be there and do the trade manually or something like that. Just have a last minute check, to know if your 5 minutes or 1 minute, whatever you decide, makes sense or not, depending on how far you are from the middle part of the range or how close you are to the extreme of the range. So that's what you could do. Okay. Another thing you can do, which is also manual, okay, because the beauty of what you have done is that it's not manual. Okay, you have a 5 minute risk, but it's not manual. Another thing you can do that removes more of the problem but is more manual, would be that you buy a call, you buy a new call. Okay, so for example, in this case, so you were long 106 and you were short 104. Okay, so let's say you are close to the top of the range. Okay, so you don't know if you will surpass 106 or not. Okay, you don't know. But certainly, let's say you are way above 105. So what could you do? Okay, what could you do? Well, what you could do is buy the 105 call, because as long as you may not be above 106, but as long as you are above 105, that one will be assigned, that one will be exercised. So you will find yourself out of the trade with no short shares. So that will create the same effect. Now, of course, you have to buy the 105, meaning that you have to pay for it. Now, of course, if you do this like 15 minutes before the close, how much time value left you have on this one? I don't know, maybe 1 cent, 2 cents. So you're just paying a few cents to get into a call that removes those 5 minutes of risk. So what is more expensive? 5 minutes of risk or 5 cents of time value? Well, I would say 5 minutes of risk is riskier, because sometimes, especially after a week, especially if the week has been a strong week up, there is a lot of profit taking. So you may have a little bit of a mini crash in the last portion of the day. And buying the 105 call may be a safer bet. But at the same time, again, we go back to liquidity. Some stocks that have options that are not super liquid, 15 minutes before the close, they may show you options with basically you have a bid, but there is no ask. So in other words, no one wants to sell the call to you, and you cannot buy it because there is no liquidity. Okay, so, and it's just because the option is about to expire in 15 minutes or 10, and then there is no one selling it to you. Market makers don't care anymore, right? So could be the case. Okay, so again, it's either you do it manual, and if you do it manual, I think that instead of looking at where the stock is compared to the range and guessing what's going to happen in the next 5 minutes, I think that's more imprecise. And then I will go to buy a call which is intermediate. I think it's a safer bet for you to exit the trade, even though you need to pay a few cents of time value left. Okay, but that may not be done. That may not be able to be done with stocks that are not liquid. Okay, or the other way to do it is, okay, just assume that you got 5 minutes of risk, which is fine. It's not gonna kill you, and use the automatic way on how you did it, which you did it perfectly, and that way it's totally effortless. You don't have to do anything manual, and that's it. Okay, so those are your two choices. And of course, we cannot know for sure where the stock will end up because we don't have a crystal ball, right? So you need to have a call. You need to have a specific action based on common sense. Very close to the final trading time of that final day. Okay, that's my answer to you, Ruben. Okay. Yeah. Where's Dubai? Good tip buying the call. Very good. Perfect. Okay. So Ruben, I think you got your answer. Very nice. Very good question. And by the way, you are showing me or showing everybody as well that you are putting your time and your effort and you are taking this very seriously. Okay, which is very very appreciated from me, because obviously it's Sunday. We are all here putting time and effort into this, and it makes my day when I see that you guys are applying it and putting your effort too. Okay, so good job, way to go. This is how you become a trader. This is how you become a super trader. Okay, so keep going, and keep up the good work. GWAC, but why buy a spread which is separated by more than one unit? Okay, well, sometimes it gives you a better result when it comes to the reward and the risk of the trade. Okay, and also sometimes it's because of liquidity situation. Sometimes you may, that's the thing about options. Every option chain is different, right? So maybe you are looking, especially with options where you got 0.5s. Okay, so for example, let's say you have an option chain where you have the 111, then you have the 110.5, and then you got the 110. So maybe you try to do an iron condor where, oh, I just erased my drawing. I didn't mean to do that. Sorry, guys. Coming back. So let's say you have an option chain, which is 111, 110.5, and 110. Okay. So maybe your intention was to do, I want to buy the 110.5 call and I want to sell the 110 call. Okay. Maybe that was the intention. Only use one strike. Okay. But, many times you will find that the 0.5 strikes got less liquidity compared to the strikes with no decimal place. So in cases like that, you may end up doing 111, 110. And you may say, well, why is it that there is a strike in between? So that may be the reason. Or maybe it's because, given the liquidity or given whatever other reason, you get more premium, you got less premium for the 111. And then basically you end up with a better credit net. I mean, you will always end up with a better credit the further away the option you buy is. But in this case, in proportion, you may get with a better credit and you could do the trade with less contracts. Okay, so we've done this sort of exercise in trading sessions where sometimes you'll see me test the near strike and the strike after, and sometimes I recommend to use the strike after because you can get the same premium with half of the contracts. So yes, you get double the risk, but you have half of the contracts, which is same risk and less slippage. Okay, so the thing about trading options, GWAC, and this is a very good observation and question as well, is that every option chain is unique, and even for the same stock, you change the expiration date, and sometimes each expiration date for the same stock is unique. Okay, and it gives us a little bit more flexibility there to apply ourselves when it comes to the specific trade that we come up with. Okay, good. So this was one question that I wanted to answer for you guys. Very good question. More questions I have here. Okay, so this question may be anonymous, okay, may be anonymous, and therefore what I'm gonna do is I'm gonna just bring it here and I'm just gonna paste it, okay, so we can read it together while I don't have to reveal the author of the question, okay, and that way everybody's happy, okay. So question number one. Okay, so assuming you don't use a time stop, when do you exit a trade that hit entry but has not yet reached the safety target? When there is a change in climate, or are they other times? Well, when there is a change of climate, you just get out, whatever price that is, which could be a small profit or a small loss. Okay, and there is no other time because given the distance from entry to safety target, it's either you hit the safety target or you don't. And actually, I would be shocked in most cases if there is a change of climate before reaching safety target. Okay, normally you would first hit stop loss and then realize there is a change of climate. Okay, because again, the fact that the safety target is so close would imply that not much would change, including the climate, for the safety target to be reached. Okay, so that's why we use time stops, to have a way to act if the safety target was not hit, to anticipate a potential change of climate. Okay, but anyway, let's say your safety target was far enough where the market works in your direction, does not hit the safety target, begins turning and gives you a change of climate, whatever price that is, get out. That would be the instruction. Okay. Number two. Okay, Pansy, I see you have a question. I'm coming to you right next. Okay. What changes do you look for regarding when to exit a trade that has already hit the safety target? Okay. Well, actually, we discussed that earlier today. Actually, it was actually a nice review, isn't it? So we have all those cases that we discussed, which is too far, too fast. That's one technique that we use. Okay. And then we also have the trailing UFOs, where you would just keep trailing your stop based on new UFO forms that could potentially form as price moves in the direction of the target without reaching the target. Okay. And of course, the change of climate. Number three, what happens when a UFO disappears before it triggers an entry? Well, if a UFO disappears before it triggers an entry, it means that the technology concluded that there are no on-field orders available at this moment in time. Okay, and I know when that happens is a pain. Okay, in a perfect world, the market would be static, not dynamic, and whatever you are giving it forever. That would be great. But the reality is that the markets are dynamic. They are controlled by computers. They add orders, they cancel orders, and so if a UFO was to disappear prior to triggering an entry, okay, that has one reason to be, which is the app understands the on-field orders are not available any longer. And if you were to take the trade, then you are exclusively relying on climate on indirect forces. You are not relying on direct forces. Therefore, you are breaking the rules. And my advice in this case would be cancel the trade. Don't take the trade. Number 4, regarding the close of the 4 p.m. session, do you exit all orders and positions by 4 p.m.? So that depends on your trading style. And this has pros and cons. And actually, I wanted to remind you all of a session that we did where we talk about weekend risk, the weekend risk. Okay? That was in July last year. We talked about weekend risk. Yeah, that's the one. Yes, weekend risk. So I would suggest that you look at this trade, at this session, because a lot of what is discussed in that session would basically answer your question. It has a lot to do with your trading style. Holding positions open after 4 p.m. obviously makes you a swing trader, and certainly that's a valid approach to trading. But you also assume gap risk, and assuming gap risk against you implies that you may have a different policy on how to position size based on the risk that you want to assume. And also you may want to build a portfolio where you trade multiple stocks in parallel, where some are long, some are short, or multiple currencies in parallel, which are non-correlated, where some are long, some are short, in order to create a little bit of a hedging effect in your accounts. That way, if you have a bad gap against you that hurts you badly in a position, well, it never gets to get badly. Okay, and never gets to get too bad. Okay, that's the point. So now, if you were to be very conservative, well, then don't be a swing trader and just close all your trades before the market closes, and that's it. Or trade markets that trade 24 hours, such as Forex or futures. So you would ask yourself that same question, but instead of every day at 4 p.m., once a week on Friday at 4 p.m., which is when we have the close for the weekend, because the markets that trade 24 hours, they don't close during the weekdays. So now you have more hours in front of you without the gap risk. So this is the long version of the answer. The short version of the answer is it depends on your style. Okay. Number 5, are targets still set on the common time frame for unconfirmed and +1 common time frame for confirmed climates? No, we are not using +1. We are not even using unconfirmed any longer. Okay, and I know where this is coming from. You are referring to very old sessions that we have on the channel, and you're right. If you look at very old sessions, we discussed trading when the climate is unconfirmed, trading when the climate is confirmed, and we had a set of rules that made a lot of sense, and they are very good rules, by the way. But we had a lot of confused traders in the community, so we came up with a variation of the methodology which is a little simpler, which is the one that I summarized today with this flowchart. Notice how the target and the climate are done with the same common time frame. And by the way, we need the climate to be confirmed for us to trade. There is no two options, confirm or non-confirm. If it's not confirmed, we are sent back to the beginning. Okay, so in other words, check the session that we did in October with the new flowchart, where all of this was explained. And because you have the flowchart, and then you also have the old flowchart, which is the one you're referring to. Okay, so look at the new flowchart, update yourself, and that way you'll be able to follow 100% what I do, which I think is going to be better for you to gain support. And also out of simplicity, it takes less time to identify trades. Okay, and also the reason why time and time ago we were okay using unconfirmed climates. Okay, the reason why it was okay to use unconfirmed climates, which is always less probability. Okay, it's also because there were certain tools that were not available yet. But if you look at all the tools available now, okay, if you happen to be a user of TradeStation, I'm sure you have seen me use in the sessions the auto climate in the radar screen format. And what's the beauty of that? Well, the beauty of that is that basically now you are loading many, many markets instead of few markets, many, many. You probably remember a long time ago, I used to trade only the NASDAQ and the S&P. That's it. Okay. And it was, again, because of adding simplicity for you guys. But now that we have auto climate in the format of radar screen, I can load as many markets as I want. Okay. Plenty of markets here, futures, plenty of markets there, Forex, more markets there, Forex. Okay. And now what do I trade? I only trade when I got the golden light. So basically, this is cheating me. When the climate is confirmed and I have an opportunity, I just go for it. Okay, and that way I save plenty of time, and therefore I add more probabilities in my favor, and I don't need to deal with unconfirmed climate, which are not a crazy thing to be done, but they are by definition a little less probability compared to trading confirmed climates. Okay. Okay. Pansy, question. I have been practicing in Oanda and placed 2 live trades, neither of which got filled. Oanda is still charging $10 a month for no activity. What other US brokers would you recommend? Okay. Let's do this, Pansy. Actually, out of earlier in the session, and by the way, you attended our November class, isn't it, Pansy? So you are one of the students who attended. Let me write it down again. I lost my cursor. Where are you? Okay, here we go. So you are one of the students who attended the survival to mastery class. Okay, and in that class we talked about brokers. Okay, and in that class we ended up using a broker called AxiTrader, isn't it? Now this is an Australian broker, and they only accept U.S. residents if you can prove residency outside of the US. Maybe you have a cell phone invoice in another country and you can provide that, and that's it. But this is not the case of everybody. Some of you may be US residents, and you have been asking me about what about brokers in the US. Okay, so in that session in November, we went over a website to be able to qualify the quality of some US brokers. Okay, but since then, I have been spending a lot of time myself doing more research, more in depth, and also actually I had meetings with certain companies. Okay, so if that's okay, I'm still getting some additional confirmation, because there are basically 2 ways to deal with that if you live in the US. Okay, so if you live in the US, one way is to use a US broker. Okay, US broker from the US. Okay, so your account is in the US. Okay, so that's one way to do it. But another way to do it is to use a US broker from the US, but where your account is not in the US. Okay, it's in some sort of an offshore jurisdiction, where it could be tricky, and some brokers could be cheeky. So that's why I'm doing some research to try to help finding the right candidates for you guys. But basically, if your account was not to be in the US, the beauty is that now you would be entitled to have greater level of leverage. You will be able to use pure ECN accounts, because what's happening in the US right now, it's really problematic. because basically you have very little to choose from. Okay, basically, I mean, you have like two or three. That's it, right? So you have Oanda, you have a Gain Capital, okay, which Gain Capital, their commercial name is forex.com, okay, and then you have Interactive Brokers, okay, IB, and well, yeah, you also have TD Ameritrade, yeah, but that's about it, right? So that's it. Maybe a few more, maybe three, four, five more. That's it. But given the size of America as a country, which is huge, like five, brokers in a country like US is very little. So basically, with all the restrictions that kick in during the years, what those brokers have been doing is acquiring brokers, and basically it became an um almost. I mean, it's not a monopoly, but getting close to it, and basically the spreads that all those brokers provide are quite wide. The majority of them are taking the other side of customer trades. So it's not ideal. Okay. And, in trading, when we talked about Axie, for example, and in the class, Pansy, you probably remember that, we talked about the importance of having a proper routing process. We talked about something called pro accounts. We talk about ECN routing, straight through processing. So we talked about things like that, which gives you much better quality. But the problem is that the best quality for those pro accounts are not in the US. Okay, so I'm trying to look for a solution for US companies. Okay, so when you send money into your account or you withdraw profits, you can just do regular, how is that called, ACH wires, I believe it's called, right? So you can just get money in and out of your trading account very simplistically, like if it was a US broker, but at the same time with the benefits of not being in the US. Okay, and I've conducted multiple meetings with some brokers, which are kind of intermediaries, and they are resellers of liquidity pools provided by big banks and stuff like that. And I've seen things that are quite interesting, but I'm not ready to share names yet because I'm not sure they are the good candidates yet, because I'm still halfway into the process. Okay. So long story short, Pansy, if you give me a little bit of time, I will be able to provide a better answer with concrete names and concrete and specific conditions and benefits, and also the disadvantages. But for now, I would suggest that just stick to Wanda. And I understand they charge you $10 a month, but I should be done with this quite quickly. Okay, I think that maximum 1 month time I should be done with my research and the various meetings I am conducting with those guys to understand who they are. Okay, Mark. Got it. Perfect. I'm reading you one, Pansy, as well. Okay, got it. Perfect. Okay, Mark. I have at least 2 times discovered that I opened a trade on the common time frame that was in the opposing UFO on the next higher time frame. Okay. So, what is your question about that, Frank? What is your question about that? Because you're right, this happens all the time. But what's your question? Frank Cuevas, how are you, Frank? Nice to see you. An issue I have is that when I have a confirmed climate, there are numerous UFOs in your way, impeding your move, and on a larger time frame price is bouncing off a UFO in the opposite direction. Um, Climate, but price has hit a red UFO and is coming down from the higher time frame, and vice versa. Mark, we are in the same wave. Got it. I hear you. I get you. So I guess Mark is probably phrasing his question. Uh, Frank, yourself as well, you have a comment more than a question, but I'm kind of reading between lines what your question is. Okay. And the way I'm gonna answer the question I think you have is by asking you a question, which is, on those higher time frames that you mentioned, have you ever seen price go through your trading zones? And if so, does it happen often or does it not happen often? Okay, and when I say often, like Frank, for example, and Mark as well, I know you guys have been putting time and effort and practice. So, and I don't know if you will be able to quantify what I'm going to ask you now. Okay, but you have to quantify it. Not today, but you have to quantify it when you can, because what you don't want to do is to trade based on impressions. You want to trade based on tangible data. Okay, so what happens more often? To see bounces from the UFOs from the edge time frame in the direction of the climate, or to see bounces from the larger time frame UFOs. Or another way to say that is what happens more often: to see your larger time frame UFOs get traded through and violated, or get your edge UFOs get violated as long as they were in the direction of the climate. What happens more often? Okay, that's a question that I would like you to think about, and I'm gonna explain why I ask you this question. So Mark said, should we check the next higher time frame as a step in finding the final target? I don't have statistics because I don't check it every time. Exactly. Okay, good. Got it. So that was the question I was reading between the lines, Mark. Thank you for phrasing it. Okay, but this is kind of what I was asking for, or anticipating. So the answer is, remember, the climate, okay, not only tells you the right direction in which to trade, or if it's time to trade or not, but the climate also reveals something very important, which is, in an up climate, buy on field orders will tend to be added, where sell on field orders will tend to be canceled. In a down climate, sell on field orders will tend to be added, where buy on field orders will tend to be canceled. Okay? That's what the climate tells you. In other words, if you see a UFO, which is a rival UFO, meaning is contrary to the climate direction, in a larger time frame, and price is already bouncing from it, in my mind, you should be happy instead of concerned. Because the fact that price is bouncing from it means that UFO already got orders to be filled. So you got less on-field orders left. And because the climate is in that particular direction, those on-field orders left are more likely going to be canceled and more buy orders to be added, that UFO is going to totally complete and reverse the climate. Unless your statistics when it comes to sustainability are not in the right position. Okay, so like when you look at your stats, for example, you look at here we got 8 out of 2.6. Okay, so that market has been moving up way too much. If there was to be a red UFO right here in a larger time frame, would that be concerning? Certainly. Why would it be concerning? Because this market already moved way more than what it should do based on stats. So even though the climate is up, it's not likely that buy orders will be added. And if buy orders are not added, probably the sell orders may reverse this thing and become a down climate. So again, looking at the stats, okay, looking at the stats in your climate analysis, it's probably way more relevant than looking at another time frame. And you don't need to make your trading process that complicated. Okay. But again, if you want to make it a rule and you have a specific rule and you don't mind to do one additional step and you add one more box to the flow chart and so on, not a big deal. But what I'm also reading between lines when I see a question of this nature, which please don't get me wrong with what I'm about to say, because it's human nature, okay? But what I also read between lines is a little bit of a perfectionist approach to not to be open to losing a trade or always willing to be right. And even though your intention may be very good when doing so, the problem is that you are trading with the wrong mindset. And that's then a problem. Does that make sense? So I know a collection of you that are in the session today and others that are not in the session today, which started trading live during the month of January, following the rules religiously, and you ended up the month profitably. Okay, so is there room for improvement? Always. Can you make more money? Always. Can you take more trades? Always. Can you increase the size? Always. There are many possibilities to keep improving. But don't be a perfectionist, and certainly don't trade in a way where you're looking for the magic formula, the magic methodology, where now you're never going to lose any longer. It's just impossible. There are too many people trading the market nowadays, including computers. You cannot run a methodology where you profit 80% of the time, 75% of the times. It's just not going to happen. So be happy with 50s, 60s, or low 70s. Be happy, because that is the sign of a super trader. Is that making sense? No need for you to be right 90% of the times for you to be satisfied, because if that's the case, then you have not understood trading. And I know that this could be the case or may not be the case with you, Mark and Frank. I mean, I know you guys have been exposed to the markets for a long time, so maybe I went a little too far with my statement, and maybe half of my statement may apply to you, and the other half applies to other traders that are still in discovery mode. I know you guys 100% understand that trading is also knowing how to lose, and you got that well understood, and you are mature in this sense. So don't get my comment wrong if maybe I went a little too far, because certainly we may have other novice traders or less experienced traders in the group that may be looking for that perfection. And when I say that, by the way, make sure you understand, it's kind of like looking at myself in the mirror years ago, because I was indeed looking for perfection. Okay, so just have rules, make sure your rules give you an edge, and then execute the rules. That's it. If you have quantified that some other time frame it's giving you an edge by looking at rival UFOs, and you have it quantified, and you have a process with rules on how to use it, then make it part of your rule, make it part of your process, and then your trading process will be a variation of mine, and it's fine. I just did a rhyme. And you'll be a good trader, and I'll be a good trader. Is that making sense? There is no right or wrong in trading, but make sure you are not concluding whatever you concluded out of an impression, because you have observed many charts and you got the feel that, oh, you know what, this happens many times. Okay, this happens many times is a feel. Just quantify it, document it, then run the stats, and then you will know if it's a real fact or not. And if it's a real fact, then you can go ahead and include it in your methodology as an additional step. Why not? But I would say it's probably not needed. Okay, Frank and Mark, even though it's a valid observation and certainly a great opportunity for me to review certain key aspects of trading. So thanks for the question, guys. Frank, larger time frames usually hold, and I talk myself out of trades when I see opposite UFOs in that way. Yeah, but Frank, and I get you, and I know where you're coming from, and I so get it. But let me ask you this question: have you ever taken a trade and you took profits, and then it just kept going and going, and it was way too early, and you get my point? So why did that happen, right? And so what if a few times a year you took a loss because you didn't look at the larger time frame, but also a few times a year you allow yourself to ride the climate longer in that same direction? So at the end of the year, who made more money? Okay, and I don't know. It's just open thoughts for you to think about it and understand the importance of quantifying it, which maybe you have done it, Frank. I know you are a mature trader and very experienced. Okay, so I'm not saying that you haven't, but it would be important for other traders listening to this conversation that before you take a decision, you quantify it so you know what is helping you and what was just an observation. Okay, that was producing an advantage during a period of time, maybe 2 weeks, but then not producing an advantage in the next 2 weeks. Okay, so yeah, so that's it. Okay, I'm making my comment maybe just a little too long, but again, it's an important and sensitive one. Okay, cool. And I believe I have one more question. Let me see. Yeah, one more question here. And this would be the last question. Okay, guys, the last set of, it's actually 3 questions, okay? But this will be the last set of 3 questions, and then I will let you go. It's been a long 2-hour session, guys, and you guys are amazing, and I just love how you share your passion, like myself, okay? We love trading, isn't it? So here we go. So number 1, Well, number one is a follow-up from another question, so I'll skip that one. We will answer this one in the email to this particular trader. So how do I backtest strategies using the UFOs when you go so far back they don't appear? Okay, so I'm not sure if the trader is utilizing either TradingView or TradeStation. Okay, but in both cases, we have a limitation and we have a solution in both cases. Okay, so I want to show it to you quickly, as well as how do I set up multiple screens, which that one is clearly a TradingView question. Okay, so let's get into TradingView. So let me get here into tradingview.com/charts. Okay. Okay. So here's TradingView. Here we go. We got the Bitcoin. Okay. And first of all, notice that TradingView goes as far of however far it goes. Okay. And how far TradingView goes depends on the symbol that you load, depends on the time frame, but also depends on the type of membership you have. Okay, so for example, in my case, I have a premium membership. Okay, so if I look at my TradingView profile, you can see here it shows as premium. Okay, so I have a premium membership. Okay, and many of you may be using TradingView for free. You don't need a premium membership. Okay, so actually, when you get into tradewithufos.com/tradingview, okay, and by the way, if you have not done it, you should. You have access to something that TradingView calls the basic plan, which is free, as you can see. It's free forever. Okay, very nice. And it gives you charge for free. It gives you lots of things, but also it gives you some limitations. Okay, so for example, how many charts per tab can you have? One. If you want more charts, you need to use the Pro plan, the Premium plan, the Pro Plus. So for example, the last question you were asking was, how do I set up multiple screens? Well, in that case, the first thing you need to make sure you do with TradingView is to get at least a Pro plan. So you would just click in here and then you get a Pro plan. And by the way, let me give you a tip, okay, a little trick. So the TradingView Pro plan is $12, okay? But when you click on it, okay, what TradingView will do is that they will give you 30 days for free, which is a nice to have, so you can test it and try it and so on. So that's nice, okay? But my point here is that even though you can see that the Pro plan is $12, you have an opportunity to pay half of this, and to be able to get these particular memberships at half the price. Basically, the way to do it is get the 30 days, okay? Get the 30 days, which is free. And then, I don't know when exactly, I don't know their process by heart or anything like that, but let's say 15 days later, they will email you and they will remind you, hey, 2 weeks from now, your free demo will expire, make sure you subscribe, okay? And, they will remind you, it's $12. So what you do is to ignore that email. And a few days later, 1 week later, whenever, they will send you another email and they will be like, hey, your plan expires in 1 week. Here's a 20% discount. So if you want to get into it, instead of $12, is discounted by 20%. So you just ignore it, you just wait. And then a couple of days later, you will receive 30% discount, then 40% discount. And then 1 or 2 days or 3 days before it expires, you'll receive a 50% discount. That's when you grab it. And that's when you get half of the price. Okay, so this is how you do it. And notice that this is a requirement that has nothing to do with our apps or anything like that. It has to do with how TradingView works, okay? Which in this case, for you to get more charts per tab, you need a plan which is beyond the basic, because the basic gives you 1 chart at a time, okay? Cool, that's one thing. Now, what else? Well, for the back test, normally you want to use bar replay. That's how you do the backtest, okay? So bar replay means that you come in here, whatever time frame you use, okay? And you're like, okay, let's say you use a 21-minute time frame, okay? So you load the 21-minute time frame and you're like, okay, so let's backtest, okay? And you go back in time, whatever amount of time you want to backtest, let's say, 3 months, whatever. So you go back in time, okay? You click on replay up here, Okay, the moment you click replay, you got this vertical red line. You bring it to that location. Okay, and the moment you have it, okay, notice how I have my replay bar here. Okay, so you can make the replay to be faster or more or slower, and then you just click play. Okay, you click play, you see what happens. Okay, so it went to the green, went to the red, from the red it came to the green, a new green shows up. Okay, a new red shows up, a new green shows up, orders coming to the market, right? And this is dynamically how the markets work. Okay, and now you would be able to basically review if the trades that you have executed work or didn't, and using a spreadsheet or any other method, you could track your results. Okay, and fast forward your learning process, fast forward gaining experience with your methodology, fast forward building confidence, which is key to traders, etc., etc., etc. Okay, but again, coming back to the different plans with TradingView, for the bar replay, with the basic plan, okay, here on the top, with the basic plan, which is free, they allow you to do bar replay with daily, weekly, and monthly. But you could not do replay with intraday timeframes like I just did with the 21-minute time frame. You could not. For you to do replay with intraday timeframes, you need to use any of the plans on the right. Okay, so it's either you use your 30 days and you really concentrate so you can do all your backtest in 1 month, and then you do it for free. Or if you need more than a month to do your backtest, then you will need to be subscribed to any of their plans to have this functionality. Or if you want to just do, instead of backtest, forward test, which is you just plan trades and you trade in demo and you just log your results and then you review your results. That's another way to do it, but of course this takes more time. The fastest way to fast track the speed at which you learn and you understand the methodologies to do bar replay. Okay, at least that's my favorite way to do it. Okay, so that's how you do it with TradingView. And with TradeStation, well, TradeStation, to be honest, has a lot more functionality in one hand, because you get probability stats. And so let's say you're gonna trade a market you never traded before. So let's say you want to trade crude oil and you never traded crude oil before, and you never traded the 21-minute time frame of crude oil, and now you're gonna trade it. Well, guess what? Even without trading, 67%, given your calibration settings, is gonna be the performance that you get. So that's gonna really help you to build up your confidence and your process and so on. But at the same time, I cannot go back in time and replay. I cannot do that. So the only way to simulate a replay would be to change dates on TradeStation. So you could come here and say, hey, show me February 1st. Hey, show me January 31st. I could change dates. Okay, that would be a way to simulate a replay on TradeStation. But unfortunately, the only thing you can change is the date. There is nothing where you could change the time. So in other words, if you're gonna simulate replay on TradeStation, you need to start with the daily time frame. You cannot do it on anything lower than daily because there is no way to change time. You can only change date. Okay, so the best way to do your backtest, to be honest, is actually TradingView. It's more efficient than using TradeStation, as I just explained. Okay, so I think this will take care of those questions. I will take a look at the last questions here. One sec. Mark, I guess that using the higher time frame for the final target could prevent an entry into the higher time frame opposing UFO. What you are saying is its occurrence, it's not often enough to affect profits. Yeah. I mean, when you compare, Mark, and again, I have this documented in my own trades, so that's how I know for myself. I really strongly suggest that you do it for yourself as well. But when I compare for myself, in one hand, the amount of trades not taken because of that were profitable compared to the ones that were losses, and the size of the profit versus the size of the loss. And then I compare what if I had taken profits at these levels instead of those other levels. Again, the methodology that makes the most sense, especially if on top of all of it you add simplicity in the sense of keeping the methodology simple to execute, because simple equals less mistakes, and less mistakes equals less losses. When you put it all together, okay, the methodology we run is okay. Okay, is okay. Of course, the key is following the rules and managing the correlations. So I mean, if let's say you run the methodology, but you are long the euro, the pound, and the Aussie, and you get stopped out on the three at a time. So I mean, for sure, you were tripling your risk by shorting the US dollar three times, right? So there are many other aspects that impact the net result of the trades. But if you were to think of one chart at a time, my comments are certainly valid. But again, all of us are coming from a different place, and actually some of you may be combining other methodologies too. Some of you may be doing, hey, you know what, I'm going to take a trade using this UFO because I have a moving average, but on top of that, I am going to overlay a collection of fib retracements, okay, fib retracements, all the way from here to here, okay, and look at that. I got a Fibonacci line lining up with the UFO. So I'm going to take this trade because of that, and I'm not using fibs in the sessions, okay? Again, sky is the limit. There are a million ways on how to trade. But in the end, you need to find balance, okay, in the amount of times you profit and the amount of times you lose, the size of the profits, the size of the losses, the simplicity for you to execute, and how many trades you find per day, how much is the effort, and how frustrating are your results, if any. Because if you have a methodology that you only execute one trade a month because your methodology is so amazing on paper, where the statistics are so amazing on paper, and you only trade once a month because every trade is so unique, but now the last 3 months you lost 3 trades in a row, which could happen, you may give up in trading for the whole year. So frustrating, because you thought your methodology was invincible, and there is no such a thing. So I prefer to trade a methodology that is vulnerable and understand the mindset of a trader, and trade more often. And when I lose 2, 3, 5 times in a row, it's okay. As long as I have a process that I know overall is profitable, I'll keep doing it, and then I make money at the end of each month. But again, it takes a stronger mindset, maybe more practice, certainly backtest, and all those different things that we have discussed. Okay, I'm just going to trust you. There is no way I can do what you can do in figuring this out. Mark, you're very kind. Um, I mean, certainly, I really appreciate your words. Okay, and it really means a lot. But remember, there is one more thing I cannot do for you, Mark. I could provide an amazing methodology to you, but there is one thing I cannot do for you, which is that you build your own experience and your own level of confidence, which goes hand in hand with who are you as a trader when it comes to your own trading psychology. This is not something I can do, So certainly I recommend you that, without falling into being a perfectionist, I recommend you to run some backtest, some practice, some paper trading, maybe some trades with less size at first, up to a point where you get to develop that level of confidence, knowing that you have a process that makes sense, but you also have a certain level of confidence. So when you need to overcome challenges in trading, you don't overcome challenges because you trust me. You overcome challenges because you know what you're doing. Okay, and again, please don't get me wrong. You make my day by saying that, and it really means a lot. But at the same time, we all live in different parts of the world, and it's not like we sit next to each other to trade. And there are many trades that you execute on your own where I'm not around. And therefore, apart from trusting me, you also need to trust yourself. And that will not happen unless you develop confidence. And confidence will not happen unless you practice, at least for a while, which I know you do, by the way. Okay, but you need to practice in that direction. Don't practice to research what is an amazing methodology. Practice to collect data of your methodology so you know what to expect from it, so you have confidence when you apply it. Okay, that's the direction of the practice, instead of looking for, oh, look at that, this happened, oh, look at that happened, oh, look at that happened. I mean, there are so many what ifs and so many situations and so many possibilities, is infinite. So instead, focus on your process and quantify the outcome of your process applied by you, the trader, the human trader, and get to that level of confidence, so you can trust yourself. and you don't need to rely on others, including me, even though really, again, Mark, it means a lot. But mm, it's about real trading. Is that making sense? You flatter me certainly, and it feels so good. But I want to make sure you're capable of doing. You and everybody can do this on their own, in a way that is, piloted by you, and not by me. Okay, because again, we get together 3 times a week, sometimes two, but you are in front of the computer as many times as you want. Okay, so my goal is to create independence in you instead of dependency from me. Okay, that's maybe another way to phrase it. Okay, cool. Okay, so Bojan, speaking of other parts of the world, when are you coming to the US? Not sure yet. Not sure yet. But I will. I will. Um, well, Bojan, there is something quite important in my personal life happening right now. So, short term, it will not be possible, but I will. Mark, I agree. My confidence is higher than it has ever been because of participating in the method on future. Glad to hear, Mark. Bojan, Mark, I see you drop in Discord every once in a while. Come by tomorrow. We'll trade live. Wonderful, wonderful. And this is another aspect, okay, of building up confidence and so on. You need to build trust in yourself, develop your own experience, but also speeding up the process has a lot to do with seeing others do it, seeing their mistakes, learning from their experiences, being guided, being kept accountable, so you don't experience, what happens when you break the rules, and you stick to the rules all the time. All those things are important, and very kind of Bojan to make you participate, of you and everyone else of his sessions too. Okay. By the way, talking about Bojan, I don't know if you want to share, Bojan, but can I share? You okay if I share? I share for you, and you may compliment on the chat box what I'm about to say. Yeah, Mark, no problem. Mm, Market will always be there. Okay, so you're taking a class next week, and this is absolutely fine. So yeah, what I wanted to share about Bojan is I'm really proud in many ways, and one of the ways as well is that, apart from becoming an amazing trader and being an amazing trader already, it's also the fact that Bojan has been so helpful with the community in so many ways. You just saw, you know, uh, the invite to Mark and everyone else to his Discord sessions and so on. But beyond that, Bojan also is adding structure to his support to the community, and he's having fun with it as well, and enjoying it very much. And what I'm saying with all of this is that he recently published a course that he produced in Udemy. I don't know if you guys are aware of Udemy. Hey Novi, how are you? Very nice to see you. So Udemy is a fantastic website where you can, just purchase a course on how to do makeup or use a spreadsheet or anything. And he's also published a course on the do's and the don'ts of trading, which is very, very nice. Okay, so um, look for him in Udemy. His course is called Trading Simplified: Do's and Don'ts in Trading. So if you wanna attend his course, you can do a search on udemy.com. I'll write it in here, udemy.com. Okay, and the name of the course is Trading Simplified: Do's and Don'ts in Trading, or do's and don'ts something. Anyway, if you have a link, a direct link or something, Bojan, you feel free to paste it on the chat box. You don't have to. people can find you just by typing this in Udemy. But if you have a direct link or something, probably is useful for the students and the traders here. But anyway, that's it, guys. We're gonna conclude the session here. 2 hour 20 today. You guys are champions. Oh, got it. Okay. So yeah. So then, if you cannot paste the link, so then everybody just look for Bojan, the way I said, trading simplified, do's and don'ts, and that's it. Anyway, everybody, you guys take care. See you soon. See you next week for the get together live. See you then. Bye bye, everybody.